Okay, everyone, we've got Walmart and Home Depot earnings. Let's get into it right now. We're going to react to a couple of clips from CNBC talking about these earnings, and then we're going to talk about if these earnings are good or bad for the market. Let's get into it.
Let's take a look at shares of Walmart. That company just out with its quarterly numbers, and check this out. The stock is up by 5.5%. Adjusted earnings came in at $1.50 a share. That was 18 cents better than the street was expecting. Revenue also beating the street's estimates. And the retailer is announcing a new $20 billion share repurchase program. If you're looking at some of the numbers here, it looks like Sorry, I just lost the line in the sales. Okay, so international sales, $25.3 billion. Revenue was up by 9.8% in constant currency. And then if you're talking about the comp store sales, they were up by 8.2%. The company's CFO, John David Rainey, talking to me a little earlier this morning and just giving us some of the guidance of what they've happened here. Inventory is a huge question. Inventory levels, he said, are really getting to the point where they're under very good control. They feel good about what's happened there. In the first quarter, inventory levels were up in the mid 30% range. By the second quarter, it had come down to the mid 20% range. Now it's at 13%. And by the way, 70% of that is inflation. So they said from a unit perspective, things are going great. That's because of canceled orders, more markdowns to clear the inventory. It just said they're in a much better place on the inventory front.
So that's really important because remember the reason Walmart collapsed 10% last time, which was the first time it collapsed 10% in a day in like 10 years, was because inventories weren't under control. So inflation was still a little bit bad, but also they had so much excess inventories and they didn't know what to do with it that a lot of people were like, well, you're just going to have to end up taking losses on those TVs that you can't sell, right? Because you're not going to be able to sell those TVs. So this is actually a really good thing that they're seeming to get inventories under control. $20 billion share buyback program is also really good. I mean, if you're a shareholder, the company is buying $20 billion back of stock. That means you get less diluted. You own more of the company because your ownership percentage of the company increases as shares get bought of the company.
The Wall Street Journal story over the weekend that suggested Walmart was really putting the squeeze on its suppliers and trying to stop inflationary prices from getting passed on to them. I asked John David Rainey about that, and he said, we always work with our suppliers to make sure that we're being competitive around cost and price for our customers. That's really not anything I would say is new. It's more ongoing business for us. Now, as for what they're seeing with consumers, there have been some shift in the purchases and the purchasing habits. He said that there's less money to spend right now on general merchandise, so they've seen a lot more shift to food and consumables. And obviously, margins are hurt by that because general merchandise has higher margins. If you're talking about food and consumables, that's responsible for their gross margins dropping by about 80 basis points year over year. So they are seeing people shopping around holiday sales when things like televisions, electronics, or air fryers go on sales. People are waiting for those sales and they're buying on them. But you are seeing customers trade down too. A lot of cheaper proteins are being bought in the stores right now. Things like beans, hot dogs, peanut butter, seeing much higher sales of those things. Although he did say that the market share that they've gained in the food business, 75% of it is coming from households that make over $100,000. And that may tell you that some people making over $100,000 are also feeling the pinch right now. Walmart says they're trying to do their best when it comes to things like Thanksgiving dinners, and they're making sure that the basket it takes to make your Thanksgiving dinner is not going to cost you any more than it did last year. They're talking about turkey, mashed potatoes, cranberries. I asked for the price point on that. He said it's somewhere between $70 and $80. Also asked what that meant. Is that the suppliers that are taking the hit or Walmart? And he said it's a little bit of both. That's stock right now up by about 6.5%.
Okay, not bad. So Walmart's earnings overall seem pretty good. Obviously, inflationary pressures are down, so that's helping. Inventories are being more under control, which means they're going to be able to distribute inventories a lot better, especially with Black Friday and Thanksgiving coming up. The fact that they're also trying to control costs for Thanksgiving is really important because a lot of people rely on Walmart in the country to be able to use it in an effective way, right? To be able to get their basic needs met. Let's go into Home Depot earnings and see what this says. Now, the reason these are so important is because these are big box retailers. So as a result of them being big box retailers, the things they say really matter, right? It gives you a sense of where things are going for the general economy and how things are playing out.
But these numbers, at least at first blush, look like the company is able, well, it's up 4 points already, to, I don't know, do whatever it does. The business model works at Home Depot, regardless, it seems like, of the environment. The estimate was for 412, and the company earned well above that. Where's the number? 424. The revenue number, $38.9 billion for sales. I believe that's also above. And then same-store sales, they had forecast 3%. And in the U.S., it was up 4.5%. No, U.S. same-store sales, 4.5, and total same-store sales up 4.3. Now, for fiscal year, they still see just 3%. So they beat currently, reaffirming guidance in the quarter and for the year. And operating margins, the company still sees 15.4%. So let's talk about Brian Nagel. He may be able to explain. Joining us now, senior research analyst at Oppenheimer. And that's what we always ask, 7% mortgage rates. Does just a bad sentiment, a bad feeling in housing, does it ever affect Home Depot? People were worried it might because there were some other companies involved in that market differently, but Home Depot seems to just shake things off and just keep rolling. Right, Brian?
Hey, Joe. Good morning. Yeah, look, I think so. I'm just digging through these results now, and I mean, they're very boring, which is actually quite good. You know, as you laid out. I mean, it's
boring is good. There's usually nothing exciting, which means the business is running normally.
It's an easy beat from Home Depot, and this is coming despite all these concerns about housing slowdown in the United States. But look, I think it just shows how well positioned Home Depot is, how well run this company is, that the company continues to put up these type of numbers despite, look, there clearly are some housing pressures out there. I think there's more housing concerns within the market, but Home Depot is performing very well here.
It's just odd that we're not in a recession, hopefully, but in a slowing economy or in a recessionary environment, you would think people might not choose to do remodeling or home improvement. So it doesn't just have to be new home sales or mortgage. They may not take a loan with rates higher, may not have to do that, but it just seems like they would get less aggressive about making improvements. And that has not been the case yet, Brian, or as you say, they just manage it so well.
Well, look, I think it's a very interesting dynamic right now. So clearly, if you look at the housing data, housing turnover is slowed. Home sales are slower, okay? But that in and of itself is actually a very small piece of Home Depot's business. Where Home Depot really plays, so to say, is in more the fixing of existing homes, the enhancing of existing homes. And right now, I think, again, despite a lot of concerns out there, I think the consumer is actually in good shape. So in a way, and Home Depot's mentioned this, I've talked a lot about to our clients, I think these higher rates are actually a benefit for Home Depot because they're keeping people in existing homes. They're making.
That's a very good point. So as you can see, Home Depot revenue beat $38.87 billion versus $37.96 billion. The point that he's making here is incredibly actually sound. If you're in your existing home and you don't want to buy a new home, well, why don't you want to buy a new home? Because interest rates are ridiculous. You're like, I'm not going to pay 6-7% for a 30-year fixed mortgage. By the way, my parents just bought a house in December 20. They got a 3% one, which was the best time to buy, right? But now it's like a horrible time to buy. So if you're going to stay in your existing home, then you're going to buy things to fix up your existing home. In fact, as ironic as this is, we just got some new tiles for the bathroom, and I'm pretty sure we went to Home Depot to get those. So like, we're not planning on buying a new home. Interest rates aren't incentivizing enough for us to want to buy a new home. So if we're going to stay in this home, and the goal of Home Depot is to buy things not for a new home, but to refix your old home, right? Because you want to do repairs and all this maintenance and all this stuff, then that's actually a great logical reason on a macro for why people would want to shop at Home Depot and why interest rates are actually good for Home Depot.
People less likely to change to new homes, and then those people are basically enhancing their existing homes, and that's a benefit to Home Depot. So I think we're in this spot right now where consumer confidence is actually still quite good, particularly amongst core Home Depot type consumers. Now, if the economy were to go into recession, if we were to go into a slower consumer spending environment, that could be bad. But we're not there right now. Right now, we're in a slower housing environment, but the consumer is still holding up quite well.
So how can you tell the difference between something like some analysis pointed to Masco? They make a lot of paint, or 3M, which is involved in building materials, and both pointed to softening demand in home improvement. Is that how they cover? Is it a different business mix at those companies, or are they not managing through this as well as Home Depot? What's the difference? Why do they see weakness?
Well, probably a bit of both, right? I don't know those companies terribly well. Obviously, I watch them in my work at Home Depot, but what those companies are probably reflecting is the slowdown in new home building, housing starts, more than that business. Whereas Home Depot, again, the vast majority of their business is to existing homeowners, either enhancing or maintaining their homes. And so that's really a different driver than you see at some of these suppliers like Masco.
Makes a lot of sense. So this is actually really awesome stuff for Home Depot and Walmart. Now, what are the reasons this is important? Again, big box retailers, they give us a sign on what's happening with inflation, what's happening with inventories. If inflation is really high, that means people aren't buying that many products. That means they have more inventories. That means their revenues, their earnings are not going to be that good. And overall, for the macroeconomy, we should expect something bad that's going to happen, which is what we thought back in May when they reported their Q2 earnings. But things seem to have changed. It does not feel the same. And the reason it does not feel the same is because if inventories are decreasing, that means more people are buying, or at least if inventories are under control, then that means more people have the opportunity to be able to buy, or that the companies at least have the ability to negotiate with suppliers, as Walmart does with their suppliers, to make sure that costs don't get not only onto the company, but onto the consumer. This is a little bit at odds with what most of the world has been saying we're going to expect in 2023, which is this massive recession. And that massive recession partly is going to be caused by companies having to do layoffs because inflation is too high, interest rates are getting tighter, and the economy is tightening down. Jerome Powell and the Fed have to take this stuff into account. If inflation is going down, as we saw at 7.7%, and inventories are decreasing, that means there's a little bit more consumer demand coming into play. The question ultimately comes, by the way, SoFi is up 5.5% to $6.18 in pre-market, if anyone cares about that. We're about to do my morning stream as I'm recording this in the morning. If that's the case, then Jerome Powell and the Fed have a decision to make on how they think about inventories, how they think about demand, how they think about inflation, and also how they think about how big box retailers are signaling to the market that things might not be as bad as you've seen, which means maybe you don't have to be as hawkish. Obviously, CPI data in December 13th, which is a day we want to circle, is going to be incredibly important to decide this. But I mean, overall, that's kind of how Jerome Powell's going to have to think about these earnings. All right, thanks so much for listening and watching. Walmart and Home Depot. Let's see what else happens as we get closer into the last week of earnings season. We have Alibaba on Thursday. Thanks so much for listening and watching. I'll see you guys on the next one.